Hey everyone, George here. So, since we're on the topic of rentals, I have three more rental tax strategies up my sleeve that I wanted to discuss with you today that can easily save you tens of thousands. Since so many of my contractor clients have rental properties, I definitely wanted to make mention of these. And they are short term rentals, the 14-day rule, and rent arbitrage. So, let's get started. So since rentals are such a pertinent thing to contractors, a lot of contractors I know have at least a couple of rental properties. A few things I wanted to go over that, maybe you should be aware of to save yourself a lot in taxes are these three things: short-term rentals, for the 14-day rule, and rent arbitrage. So let's get started with the biggest one, short-term rentals. So the big thing about short-term rentals is if you do qualify for it, you can offset any losses from your short-term rentals against ordinary income. So that's either W-2 income, business income, investment income. Pretty much you can use those losses to offset any of your ordinary income. And the big deal with that is, since as you probably know by now, with rental properties, any losses, by default, you're a passive investor. So any losses get stuck in the passive activity loss bucket, and you usually can't offset those losses against ordinary income, which puts you at a disadvantage. Unless, in our previous episode, we went over you're a real estate professional and there's a whole slew of things to qualify for that. But with short-term rentals, if you do qualify, you could offset those losses against ordinary income. And that could save you a lot of money. Now, how do you qualify for short-term rentals? Now, you need to rent out your property on average 7 days or less, and you need to be a material participant. You need to materially participate in the rental activities of those short-term rentals. Now, the 7-day average or less rule, that's pretty straightforward. If you're Airbnb-ing it, one of those short-term rental sites, that will easily qualify you. No problem there. And in terms of being a material participant, you basically need to own at least 10% of the property yourself. And on top of that, you need to, there's three main tests for rental activities. There's actually 7, but 3 which are relevant to rental activities. And that is, you need to spend at least 500 hours. You need to spend, that's test number 1. Test number 2, you need to spend at least 100 hours and nobody spends more time than you. Or test number 3, you perform substantially all of the work on the property. Now, any one of these tests, if you qualify for it, you would qualify as a material participant. So again, that's at 10% ownership plus pass one of these 3 tests. That is 500 hours, 100 hours or more, and nobody works more than you, or perform significantly all the work yourself on that property. Now, what are typical losses you can take resulting from your short-term rentals that could really help you offset ordinary income? The big ones this year are cost segregation and bonus depreciation combined. So like if you went and got a cost segregation study done, that can 20-30% of the property easily can be in buckets of 20 years useful life or less. And if you have that, you can expense all of that with 2025 generous bonus depreciation rules. Expense all that in the current year, and that will give you a nice deduction to offset your business income, W-2 income in that year. That's the big one. And any other paper losses, anything resulting from depreciation, obviously any repairs, maintenance, things like that, that puts you in a loss position. Potentially, it could create a nice paper loss for you that you offset against your ordinary income. So for example, if you buy a $600,000 cabin, you spend $80,000 furnishing it and fixing it up, and you get a cost segregation study done that gives you, between everything, $150,000 of paper losses, effectively depreciation. You can offset that $150,000 of depreciation from that property against, say, $150,000 of your spouse's W-2 income or your own business income, and that'll give you a nice return for the year. So again, short-term rentals can offset ordinary income. You just need to own the property 10% and be a material participant. Number 2 is the 14-day rule. A lot of people go by this as the Augusta rule, or you could just call it the 14-day rule. And here the IRS allows you to rent out your property for not more than 14 days and charge, fair market value rent for those 14 days and not include that in income to you. This rule started in Augusta, Georgia, where a lot of people were renting out their house during the PGA golf tournaments for 14 days or less, and charging very extravagant rents for those 14 days and not including it in income. And Congress actually became okay with that, and they completely approved that. And until today, it's completely legal, it's compliant. So you could charge your property out, an ADU out, what have you, for 14 days and not include that rental income as income to you in any way. You could even do it, rent it out to your own business and, take a deduction at the business level and not include that money as income at the personal level. And in high cost markets like LA and the Bay Area, I've seen rental rates go for $250 an hour. So, that's $2,000 a day times 14 days. That gives you a nice $28,000 deduction right there, right off the bat, that you don't need to include as income on your personal side, that you include as a deduction on your business side only. Now, what are the requirements for the Augusta rule? Number one, you must own a property. Number two, you must, in general, use it personally, like say your home. Number three, you rent it out for less than 15 days in a year. Now, as soon as you rent it out the 15th day, that whole thing should technically be reported as income. So you just have to own the property. It has to be a personal residence, rent it out less than 14 days, and you don't need to report anything as income. You don't get deductions either, but that's not a problem because you're not reporting anything as income to deduct against. Now, what are examples of, if you rent this out to your own business, what are examples of documentation the IRS would look for in the event of an audit? They would look for some sort of board meeting notes, agenda, quarterly team meeting, planning session, training session, content creation sessions, marketing photo shoots, client events. Like if you could gather up any sort of documentation in one or many of these documents for those 14 days, then you're in the clear as far as the IRS would be concerned. Again, that's a straight, in the markets that I'm familiar with, $28,000, for example, deduction at the business, not includable as income at the personal level. Now we get to rental strategy number three, rental arbitrage. This is when you lease a property out from a landlord and rent it out yourself as a short-term rental. The advantage to this is obviously there's no down payment, no mortgage, it's not capital intensive. Just lease it and some furnishings, maybe some basic repairs. Since contractors are handy anyway, it's easy to make little fixes. Now, is it legal? Yes, if the lease agreement allows for it. You have the landlord's consent and you operate it like a business. As a matter of fact, many landlords love it because they get guaranteed rent. The property is professionally cleaned constantly. Contractors tend to make all the tiny repairs themselves, and it's treated very professionally like a business asset. So you'd be surprised that a lot of landlords would actually be very much open to this. Now, the tax benefits for you on this are, even though you don't own it, you still get to take deductions for it. Rent expense, furnishings, supplies, repairs, utilities, cleaning crew, marketing, insurance, professional photography, travel, and potentially bonus depreciation on any furniture, furnitures, any leasehold improvements that you make, but not the building itself since you don't own it. And again, if you rent it out for 7 days or less on average, you can take any losses from this property to offset any of your ordinary income. So the nice thing about this is that you don't have that capital intensive requirement like the down payment and required the mortgage payments. You can go rent out a property and create cash flow and tax write-offs using that property. So again, these are 3 rental tax strategies that every contractor should be aware of. It's the short-term rental rule, the 14-day rule, also known as the Augusta rule, and rent arbitrage. So I hope you found this helpful. Click like, subscribe, turn on notifications for any updates, and hope to see you in the next one.